The biggest misconception about investing is that it's reserved for the rich. That might have been true in the past, but that barrier to entry is gone today, knocked down by companies and services that have made it their mission to make investment options available for everyone, including beginners and those who have just small amounts of money to put to work. In fact, with so many investments now available to beginners, there's no excuse to skip out. And that's good news because investing is a great way to grow your wealth. In this episode, you will learn 5 ways to start investing with small amounts of money. But before we go too far, don't forget to hit that subscribe button so you don't miss the next videos about how to invest to be financially free. 1. Direct stock purchase plans. When it comes to investing in the stock market, cost is often the barrier to entry. It takes money to make money, right? Not anymore. The internet has made it easy for consumers to get started with very little upfront money. That means you can put a few dollars in to familiarize yourself with investing before making a bigger commitment. It's a great way to learn about investing while putting very little money at risk. Today, there are increasing numbers of options that have swung open doors to a new generation of investors, letting you get started with as little as $1 and charges no trade commissions. In the past, stockbrokers charged commissions of several dollars every time you bought or sold stock. That made it cost prohibitive to invest in even a single stock with less than hundreds or thousands of dollars. In fact, $0 commissions across company have been so successful, they've disrupted the entire investing industry and forced all the major brokers to follow suit and drop trading commissions. Plus, the ability to invest in companies with fractional partial shares is a complete game changer with investing. With fractional shares, it means you can diversify your portfolio even more while saving money. Instead of investing in a full share, you could buy a fraction of a share. If you want to invest in a high-priced stock like Apple, for instance, you can do so for a few dollars instead of shelling out the price for one full share, which is around $370. 2. Let online brokers and investing apps invest your money for you. Robo-advisors entered the investing scene about a decade ago and made investing as simple and accessible as possible. You don't need any prior investing experience, as robo-advisors take all of the guesswork out of investing. Robo-advisors work by asking a few simple questions to determine your goal and risk tolerance and then invest your money in a highly diversified, low-cost portfolio of stocks and bonds. Robo-advisors then use algorithms to continually rebalance your portfolio and optimize it for taxes. There's no easier way to get started in long-term investing. Most robo-advisors require just $500 or less to start investing and charge very modest fees based upon the size of your account. All offer automated investing plans to help you grow your balance. If there's any downside to robo-advisors, it's cost. Robo-advisors charge an annual fee equal to a small percentage of your balance. The industry average is about 0.25%, so if you invest $10,000, you'll pay $25 a year. That's not a lot of money, but it begins to add up if you amass hundreds of thousands of dollars. It's important to note that robo-advisors' fees are on top of the fees charged by the exchange-traded funds, ETFs, that robo-advisors buy to make up your portfolio. You can avoid paying the robo-advisor fees by building your own portfolio of ETFs or mutual funds. For the vast majority of investors, however, that's a lot of additional work and responsibility. The bottom line, robo-advisors are cheap and well worth it. 3. Dip your toe in the real estate market. Believe it or not, you no longer need a lot of money or even good credit to invest in real estate. A new category of investment known familiarly as real estate crowdfunding makes it possible to own fractional shares of large commercial properties without the headache of being a landlord. Crowdfunded real estate investments require larger minimum investments than robo-advisors, for example $5,000 instead of $500. They're also riskier investments because you'll be putting that entire $5,000 into one property rather than a diversified portfolio of hundreds of individual investments. The upside is owning a piece of a real physical asset that's not necessarily correlated with the stock market. As with robo-advisors, investing in real estate via a crowdfunding platform carries costs that you wouldn't pay if you bought a building yourself. But here the advantages are obvious. You share the cost and risk with other investors, and you have no responsibility for maintaining the property or even doing the paperwork to buy it. Real estate crowdfunding can be an intriguing way to learn about commercial real estate investing and also diversify your assets. However, don't lay all of your money on these platforms because they do make an intriguing alternative investment, especially in these times of unprecedented market volatility and pitiful bond yields. 4. Invest in ETFs. ETFs and mutual funds are investment securities that allow you to invest in a portfolio of stocks and bonds with a single transaction, making them perfect for new investors. The trouble is, many mutual fund companies require initial minimum investments of between $500 and $5,000. If you're a first-time investor with little money to invest, those minimums can be out of reach. But some ETFs and mutual fund companies will waive the account minimums if you agree to automatic monthly investments of between $50 and $100. Automatic investing is a common feature with mutual fund and ETF IRA accounts. It's less common with taxable accounts, though it's always worth asking if it's available. Mutual fund companies that have been known to do this include Dreyfus, Transamerica, and T. Rowe Price. An automatic investing arrangement is particularly convenient if you can do it through payroll savings. You can typically set up an automatic deposit situation through your payroll, in much the same way that you can do with an employer-sponsored retirement plan. Just ask your Human Resources department how to set it up. 5. Invest with Treasury Securities. Not many small investors begin their investment journey with Treasury Securities, but you can. You'll never get rich with these securities, but it is an extremely safe place to park your money and earn at least some interest until you're ready to go into higher risk, higher return investment. Treasury Securities, also known as saving bonds, are easy to buy through the Treasury Bonds portal Treasury Direct. There you can buy fixed income government securities with maturities of anywhere from 30 days to 30 years in denominations as low as $100. You can also use Treasury Direct to buy Treasury Inflation Protected Securities, or TIPS. These not only pay interest, but they also make periodic principal adjustments to account for inflation based on changes in the Consumer Price Index. And as is the case with ETFs and mutual funds, you can also arrange to have your Treasury Direct account funded through payroll savings. This makes treasuries mostly a place to stash cash for safekeeping rather than a way to grow your money. There are plenty of ways to start investing with little money, with many online and app-based platforms making it easier than ever. All you have to do is start somewhere. Once you do, it will get easier as time goes on, and your future self will love you for it. That's it for this episode. Please give us your feedback in the comments section below. To watch more episodes on financial topics like this, hit that like and subscribe button. If you want to support us even more, buy us a coffee from the link in the description. Good luck and see you in the next episode.